You are listening to Keystone's Stock Talk Podcast, episode 143. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We have a great show planned for you this week. In our one-on-one versus debate, we debate two heavyweights in home improvement, the Home Depot Inc., HD on the New York Stock Exchange, and Lowe's companies, symbol LOW on the New York Stock Exchange. Both have produced strong gains year to date, driven by stay-at-home DIY projects and a great deal of free money and flea money slushing around in the economy. We debate which is better value today. Brennan takes Lowe's, and Aaron gives you his pitch for Home Depot. I will sit in as judge, jury, and executioner. So let's get right into our show this week. I'd like to welcome my co-hosts, Brennan and Aaron. How are you guys doing?
Doing well.
Welcome, gentlemen. Welcome. How are you?
Nice to be here.
Doing really well, doing well. Weather's getting really
Brennan
nice.
and I are back up against each other,
Ooh.
battling.
Brennan's looking for that numero uno win, the first win, right?
I'm feeling good about this one. You know, I'm usually feeling good about it, but I'm really feeling good about this one.
Oh, really?
That track
You
record
are
of feeling good.
Yep, I am.
Okay. Yeah.
We'll see how
Home
it goes.
Depot was actually part of a U.S. dividend investing report that we recently put out. So I had taken a look at Lowe's and Home Depot before and had some research on Home Depot in there. It's good now to have the opportunity to.
I purposely looked at neither right ahead of this, so I would have a fresh and open mind going in.
As the judge.
Nor should I. No biases.
Impartial.
So we thought we'd start, too, by looking at a couple points, or at least one main point that came out of Berkshire Hathaway's annual meeting. I saw a great tweet on this, and Buffett, one of his first points that he made when he was talking about the overall arching point of that he does not think the average person can pick stocks. But his first point, he talked about how the top companies, I think it's 20 companies, in 1989 by market cap in the world. None of them were on that list if we fast forward 30 years to today. It's amazing. He asked that question, how many do you think will be on that list from 30 years ago if we fast forward to today? There was zero. And it was quite the list of companies there. There was back in 1989, which this goes back to, there were 6 from the United States and 14 from other companies. The largest company with $104 billion market cap was the Industrial Bank of Japan. Doesn't even appear on the list at all. None of these companies, in fact, appear on that list. It's quite a shocking list. And today,
to see the number of Japanese companies that are on that list, basically dominating the list back in 1989.
Yeah, it's unbelievable fall for those companies, really. And then many of them just been superseded by some of the behemoths now, some of the tech giants, the Apples, the Microsofts, Amazon, Alphabet, Facebook, from China, Tencent, right up to Tesla now too. But now we have, back then, 1989 from the US, there were 6 companies. Today, 13. So the United States just absolutely dominating the top 20 companies in terms of market cap in the world. And we listed off some of those names. Not a single company from Japan there. The second largest company in the world is from Saudi Arabia. It's Saudi Aramco. Many people would not know that company, and Aaron just commented on this, it's surprising that it has a market cap larger than Microsoft, Amazon, Alphabet, Facebook, some of the giants from China like Tencent and Alibaba as well. It's really interesting. And the question posed, we saw this question posed on Twitter. So how many on today's list? And it says will even be there 20 years hence. I would go 30 years because this was 30 years ago. So we'll apples to apples there. But now 30 years in the future, how many do you guys think will be on that list?
I don't know. Maybe a couple. Go on, Aaron, though. Sorry.
Well, I was just going to say, it's impossible. Nobody knows what.
Of course, but it's hard to imagine some not on that list.
Years. But one thing that I think that's very interesting is if you look at the companies on this list, like the tech giants specifically, just in terms of the culture of innovation and how it exists in those companies today. I mean, just as an example, Google, we think of Google as search engines, digital advertising, but they're widely considered to be one of the very top, or if not the very top, AI research company in the world, right? Because they essentially, this industry, like the Microsofts, the Apple, when they first emerged, the companies that were dominating these spaces were IBM, Xerox. Those were the companies that missed out on the big opportunity that was personal computing and the internet and everything that evolved from it. But you have to wonder about how much those companies, the tech giants today, learned culturally from that. Because they seem to have such a focus on innovation and disruption and finding new ways of doing things. It almost seems like they learned something from their predecessors. There's this movie that was interesting, and it's on the movie. It was called Pirates of Silicon Valley, and it was basically about like the early days of Apple and Microsoft as they were just emerging, when they were developing the Windows systems, like the graphic user interface on computers and the mouse. And I know it's just a movie, but it's the way that the movie portrayed the culture of the giants at the time, the IBMs and the Xeroxes, is that they were just extremely rigid in terms of thinking, and in terms of how they were trying to innovate their companies. And they almost just kind of scoffed at the idea of doing something like using something called a mouse, or how, why a individual would need a personal computer. Like they were so blind to the opportunity. And that's what gave the opportunity for these smaller companies to come in and start dominating the tech space. So it's interesting. It'll be interesting to see. I mean, maybe these companies will continue to innovate and evolve over the next 30 years, and we will see a few of them.
And the question too for me would be outside of innovation, but can they, at that size and the market dominance that they have, is there the regulatory risk? Is there a breakup risk in these companies too? So maybe when you look back 30 years from now, some of them do exist, but they're in parts. So they may not be the largest companies in the world because they get broken up. But there is, I do agree with Aaron, there's more of a culture of innovation with these companies today. But, one of the reasons, to go back to what we do look at small cap companies all the time, and we're always looking for the next big company, the next company that can come in, and these little innovative companies out there, and potentially, you can find those. But, I if I had to guess, I wouldn't bet that 0 of the 20 top companies in the world today would make the list 30 years going forward. I don't think that would be my bet. I think there would be at least some of them in some form on that list 30 years going forward, because of the way those businesses differ from, if you look back in 30 years ago, there's a lot of banks, Exxon's on there, GE, Toyota, Nomura, Royal Dutch Petroleum, so Nippon Steel, all of these companies. The culture of innovation relative to these businesses 30 years ago, at these businesses, at least that's what we're told today, is night and day.
Yeah, a couple that I think could be on there, in 20 or 30 years would be Amazon and Alphabet. But, you guys will have to, or we'll have to look back at this in 20 years to, see if I'm right. But I would, take an educated guess and say that they would stay there because, they are tech leaders. I do agree, kind of with what Aaron was saying. I believe that those names are pretty nimble with, kind of adapting. And then just another point too, I think that it is interesting that, is that LVMH? Is that Louis Vuitton technically? Is that, I think they're on there as well, which just is kind of interesting that, an expensive products company essentially is up there from France. Usually you would expect it just to be kind of a lot of big tech names and innovative companies, but seeing a company like that with premium products up there, it does surprise me a little bit.
Yeah, I mean, Berkshire Hathaway's right smack middle in that list too. So a diversified product company, sure, and services as well. Now, I'm going to look at, we've been looking at some common mistakes investors make when building their portfolio. So I'm going to switch gears a little bit and a couple of initial steps that you can take when you're building that DIY portfolio. The first step that, we suggest this all the time in our DIYs is just to review your portfolio. So review those individual holdings. I would start by just take a quick look at each ETF, fund, and stock and see if you want to continue to own them. If the reason why you bought that fund or stock still exists and is still true today, it may be a company or a stock or an investment that you continue to own. If not, it can be one you sell and move to a different position going forward. If you're under diversified, look at the holdings within your portfolio. If you only own 2 to 5 stocks, for example, and we've seen that with many clients when they first come to us, that's too much company specific risk. Even if you've done all the research in the world on those 2 to 5 companies, you'd likely want to hold a more diverse portfolio. Not diverse portfolio, but diverse. We'll look at over diversified. An example of owning, many clients come to us, or we hear many stories of Canadian, US investors. They have 7 to 10 plus ETFs or mutual funds within their portfolio. This is likely far too high. In our full webinars, we typically recommend portfolios consisting of 15 to 25 high quality growth and dividend growth stocks from a diverse set of sectors. But if you add anything past 20 individual stocks, really, you're not gaining any advantage from diversification. So you can use our research to achieve this type of portfolio or someone else you trust, but know that, that you can be under diversified, which is a problem. Being over diversified in your portfolio is also a problem. The last point I'll make is high correlation or concentration or duplication of holdings. We see this a lot in Canada. I'll give you an example. There's 5 big banks, there's 6 or 7 other little banks as well. But we see many portfolios own 4 or 5 of those banks. There's just high correlation and it's likely unnecessary. Or we see in Canada, there's a great deal of the market, energy and mining. If 10 of the 15 stocks you own are oil and gas or mining related, this is far too much concentration in one sector and something that should be addressed within your portfolio. So those are some little tips you can do when you're reviewing your portfolio quickly. Take 5-10 minutes, see if you're under diversified, over diversified, or have some high correlation or concentration, or even some duplicate holdings, basically holding 4 or 5 of the big banks. You can improve your portfolio just looking at those 3 things and making some steps to build that simplified 15 to 25 stock portfolio. Save some fees and try to beat or best the market over the long term.
Yeah, excellent.
Any comments on that?
Certainly. One of the things we talked about in the DIY was that there's active management and there's passive management. And passive management is about getting wide diversification and not having to do a lot of work, just getting that market return, which you can passively invest through ETFs, indexed ETFs at a very low cost. And then active management is about investing in individual stocks so that you can outperform the market. So on your passively, if you're looking for wide diversification, maybe for all or even a portion of your portfolio, the best way to do that is to go with ETFs and not to build a individual stock portfolio that essentially mirrors the market, because you're essentially getting a market return, but for a lot more a lot more work and, potentially higher cost as well. Whereas, if you want to invest in individual stocks, the purpose is to outperform the market. So to do that, you have to create a portfolio that is going to focus you in certain areas, pockets of strength, and whereby your winners are going to actually matter and make a difference, and not just be completely diversified away, with every stock being a 1% or a 0.5% of your portfolio. So you can do both. You can have a strategy where you combine the two. You can take a portion of your portfolio and say, I want to get some wide diversification with this, go into indexed ETFs, and then with the other portion of your portfolio, you go with active management. But in order to be an effective active manager, the priority needs to be focusing in the right areas as opposed to just getting a little bit of everything.
Yeah, and I like the point too that Ryan said at the beginning is just looking at your holdings, making sure you know why you own it, and just constantly going across your investment theses on all of your stocks. And if the fundamentals are breaking down on one of those positions, not being scared and holding on for dear life, praying that the fundamentals will turn around. Sometimes they won't, and sometimes the best thing to do is, to sell the stock and move on. As we debated Apollo Healthcare a while ago, or a few episodes back, that was one where I held it in my portfolio. I looked at the investment thesis. It was sort of starting to break down. So there I went and I sold it from my portfolio and allocated it to a better healthcare stock that I liked. And so far it's been a great decision. Just constantly looking at those holdings and, making sure those investment theses are intact with the fundamentals. It's always great advice to do.
Yeah, you got it. If the original reasons or thesis for purchasing a company or purchasing that ETF or fund or index fund within your portfolio are not there anymore, then there shouldn't be much of a reason to continue to hold that going forward. It's not dependent upon where the company is in terms of the price and your return on it. It's dependent upon the fundamentals of that business at that time. If it is no longer, those fundamental reasons that you bought it are no longer there, you can sell that position and get into something that, you believe in for the next 1 to 5 to 10 years. Mm-hmm. And because it's a good growth company over the long term. So let's get into that debate. We're going to look at Home Depot and Lowe's. Just a brief on Home Depot. Trades at $330 on the New York Stock Exchange. Has about the yield is in the range of 2% right now. The market cap is about $355 billion. As far as Lowe's, trades at $199, roughly in that range. Symbol LOW on the New York Stock Exchange. It is, what's the yield on Lowe's? 1.22%, and its market cap right now is $142 billion. So significantly smaller than Home Depot at this stage. So now, who wants to go first? You have the bull case or the pro case? I guess just the case on Home Depot. Pro case. Yeah, you have the case for basically Home Depot, and he has the case for Lowe's. Who wants to go first?
Well, I mean, mine is the superior case, so I guess I'll go first.
Sure.
Well, I guess we'll say brains before beauty, or who wants to be beautiful in this one? I don't know.
I think Aaron can take the beauty.
Youth before age. Aaron wants to take both. We'll see who wins by the end.
My argument here speak for itself. I think it's both intelligent and beautiful myself, but we'll see.
Again, I've been calling you a financial model for years, right? So.
Thank you. It's very kind.
That joke never gets old.
No.
Okay, so let's get into Lowe's. Brennan, you are on the clock. I'm going to pull up my clock here. Yep. Are you ready?
I am ready.
All right, let us go. Go.
Number 1, Lowe's has been restructuring the company and increasing profitability by closing underperforming stores. Number 2, both companies had similar fiscal 2020 revenue growth of approximately 25%, but Lowe's 2020 diluted EPS grew 41% for the full year, which outperformed Home Depot's EPS growth by approximately 24%. Number 3, Lowe's currently has higher use of debt on its balance sheet with a net debt to EBITDA multiple of 1.9 times, but I like the company's use of cheap debt right now. Number 4, Lowe's trades with a PE multiple of 26 times, which is an 18% premium over its average 6-year PE multiple of 22 times, while Home Depot trades at a premium of 33% compared to its average 6-year PE multiple. Plus, Lowe's has an EV to EBITDA multiple of 15 times, whereas Home Depot trades with a multiple of 19 times. So, seeing that Lowe's trades at more attractive multiples, offers similar revenue growth and better EPS growth, I believe Lowe's offers better value going forward. Boom.
Just right at the end. Nice.
Yeah, I had to time that pretty well.
Yeah. Well, that was well thought through analysis there, and well done.
Interesting how you feel that having higher debt is an advantage.
Hey,
Yeah.
Okay. Let's
Okay,
let's do
so
this. Let me know when
Aaron,
I'm-
you're
when I'm
ready? You
I'm
are ready? All right, my friend. 4, 3, 2, 1, go.
Home Depot is the largest home improvement specialty retailer in the world with 2,300 stores in North America. Very strong growth in 2020, revenue up 25%, earnings up 16%. Revenue growth has been consistent, averaging 9% over the past 3 years. It's a staple dividend growth stock, nice yield of 2%. They just increased their dividend 10% in 2020 and 3-year average growth of 17%. Analysts are expecting growth to continue at a high single-digit rate over the next 3 years, and right now the company's trading at a valuation of 26 times estimates. Finally, relative to Lowe's, Home Depot has stronger operating margins, 14% compared to 11% for Lowe's, higher return on assets at 21% compared to 16% for Lowe's, and acquired a greater share of the market in 2020. $22 billion in additional revenue for Home Depot versus $17.5 billion for Lowe's.
All right, you got about 8 or 10 seconds to spare. You dropped the mic on that one, eh?
Should we talk about how Brennan thinks that high debt is an advantage? Okay.
Hey,
Sure,
I mean,
I think you guys can go into overtime on this one because it's a difficult case, right?
oh yeah,
So,
I mean, I was a lot more
go
confident
for it.
after I heard Aaron, but no, my case for the higher debt load is, what I would argue there is that using more of the cheap debt right now, they would technically be lowering their weighted average cost of capital. So that's essentially, why I would be going that route. Because again, a net debt to EBITDA multiple of 1.9 times, that's not bad. So it is reasonable. And I would just argue that it lowers their weighted average cost of capital a little bit.
Certainly, I'm not aware that debt is really a problem of Lowe's, and I'm not necessarily insinuating that. But I will say, everything else equal, you're in a situation where Lowe's might be closer to their maximum debt level, where Home Depot would have more capacity to add on additional debt for more growth. So I know that, as you said, it was higher earnings growth for Lowe's just in the last year, but how's that going to look going forward if Home Depot can leverage up a little bit more? Can they drive a little bit more earnings growth?
For sure.
So do we know either of the two of them what their growth rates are going, like, expected this year?
Oh, expected this year? Well, if you just go off of analyst estimates, I believe Lowe's is actually a little bit higher. I think that Lowe's was like in the low teens, and Home Depot's was in the high single digits. But that's analyst estimates, so take that for what it's worth, right?
For sure. And I think
so
reason
maybe you're getting a little bit higher earnings growth for Lowe's in a situation where the company has higher debt.
And I think what's really leading to that higher EPS growth as well is that in 2018, well, even actually around 2016, Lowe's realized that they need to kind of focus, and their comparable store sales or figures weren't looking very good. So essentially, I think in 2018, they ended up closing around 180 stores, from my understanding. So that's really, I believe, where the EPS growth is coming in line, is they're really just focusing on, I guess, getting higher margins at the stores that are actually, driving growth, essentially. So I believe that that's why the EPS is growing. But now I would argue, and again, Ryan hasn't made his decision yet, but I would argue, how much further can that growth continue by focusing on or getting rid of the stores that are lagging a bit, if you know what I mean, because that's not technically something that's sustainable for a very, very long time into the future.
Yeah, I'd be highly skeptical at 46%.
So now I'm starting
Earnings
to
growth is
taint
is not going to be realistic for the company.
Yeah.
That's
Well, I think I'm
certainly
digging
not
a
what
hole,
analysts
so
are estimating either.
I'm just going to stop talking.
So I
until
think
Ryan
this
makes a
one is
decision.
incredibly close. I think my time frame that I'm looking at would really guide me. If I wanted to own one of these for a year based on the lower valuation and higher growth rate, I'd probably go with Lowe's. If I wanted to own the maybe higher quality name for 3 to 5 years, it'd probably be Home Depot. So what's my time horizon? Aaron's going to say it's 3 to 5 years.
Well,
Brennan's going to say it's 1 year.
You advise clients or other investors typically. Why don't you go with that?
Yeah.
No.
Literally, I feel like saying if we've never had this in the history, it's like a push for me, to be honest.
Well,
it's a push.
you just have to make a call.
But
Yeah, you gotta
I'm
make
going to
a
make a call that we look 3 to 5 years out, so I'll go with Home Depot.
Okay.
No. Just kidding. Fair enough. Fair enough. I thought I had that one in the
was
bag.
the right choice.
I thought I had that one in the bag. Damn it.
Yeah, I don't know. It's kind of one of those. I was looking at it, and it's a pretty similar situation. I'm sure if one does well.
Honestly, I could go for a push too. I'm back and forth. I'm on the fence on this one. I have no strong conviction either way, so that would be, I would have to have a strong conviction to actually buy one. I wouldn't be buying either right now. I think they're, I don't think they're horrible businesses or anything like that, but I do think they've both had an uptick that likely leads to a bit of a downtick at some point in terms of growth rate. Because when people get back to a new norm, and when people aren't cooped up into their backyards, I don't think they're going to be doing as many DIY projects. I think I might not be owning them.
Extra money. There's been extra money because
all of that.
Been going to restaurants.
The spigots get turned off at some point, and people stop. Yeah. So I don't think I want to own either one for the next year or two, near term. But
you want to be somewhat cautious and think about what you're buying with these companies that have benefited from the shutdown, because certainly, I mean, a lot of people, once those borders open up, are going to want to spend more money on traveling, and that means
both
money's going to have to flow from elsewhere.
Are at elevated historical multiples too, so you're at that, which many companies are, but you have driven by consumer spending and special consumer spending, right? Like because. It's swayed towards that. It's going to sway towards travel, as a recreational activity rather than building a back deck. I mean, there's only so many decks we can have in our backyard.
Although I will say that, maintaining your home is somewhat of an essential service too. And just based on population growth, you're going to have more housing needs. But are you going to build it, or are you going to stain it again to maintain it, right? So the stain costs a heck of a lot less. Discretionary. A lot of the spending is discretionary, but not all.
Yeah. I almost feel bad for Brennan on this one.
I feel bad for myself too. Just kidding.
Or maybe
it was a good debate. I had fun.
No, it was a good debate.
It's fun when we bring companies that are so similar, and realistically, I thought I should have won, but no, just kidding. I only kid. But it could have went either way. I truly believe that.
Would you like me to go back and say that you won?
Yeah,
I'm not going to do that. Sorry. All right.
Rewind the tape. No.
All right. Well, that's going to end our show for this week. Keep your questions coming into our Your Stock, Our Take segments, our debates. If you got two companies that you would like us to put up against each other, maybe, skew one that's a better one, send that Brennan's way. Hopefully he can get a win. We'll answer those questions. And if you've got any, stocks that you want to look at in your portfolio and get a sober second opinion, we can do that in our Your Stock, Our Take segment. Continue to rate us on iTunes or wherever you get our podcast, and we'll continue to produce the content here on a weekly basis. I wish everybody out there profitable investing. Thank you.
Profitable investing.
Thanks, everyone.